Hello, and welcome to Real with Rachel, where I'm Rachel Smith, a local real estate agent with RE/MAX, and we talk a little real estate and other things happening inside of our community. And I'm super excited because today our guest is Kathy Brennan, yay, with RMS Residential Mortgage Services. She's actually our premier partner with my husband's building company, so I'm super excited to have her on. We're going to talk construction loans and what's happening on the mortgage market and different loan products. So hello, thank you for coming.
Thank you for having me.
Yay. All right, so let's get into it, guys. I really wanted to bring on an expert that had to do with construction loan products, that had that knowledge base in all things with construction loans, right? We're seeing a lot of uptick with new construction going on. Obviously, resales, there's hardly any inventory, so the next best thing, right, is to build new, which is something that we offer. And again, she's our premier partner, so we've worked with her before. So I was like, Kathy, come on, let's talk about construction loan products, because a lot of people, I think, don't realize what they're all about and what's entailed. And I think sometimes people can get a little scared of construction loan products, like just because
it's a little intimidating,
but it's really not that bad. It's pretty streamlined.
It is. We're there to walk you through it, hold your hand through the whole process, whether you have a lot or you need a lot. If you need a lot, Rachel will find your lot.
We'll find the lot, and then we'll lock it up. So typically a construction loan, is that the same application process and the same type of qualifying factors as a regular mortgage?
It's similar, but it's a little more intense. With the construction perm, it's usually going to be a one-time close. Okay. We're going to look at it a little stricter because we're going to be carrying this loan a lot longer. So, we're going to want those good credit score buyers.
Okay.
Yeah, so that,
But there's ways to help with that too.
Absolutely. We can just call me. I can help you with that.
And pinpoint it out. Now, typically with construction loans, so you go ahead and you go through the application process. Now, you're going to be applying for a loan of the full construction amount, right? Is that when it's pretty much finished, the whole total cost as to, and you can include the land acquisition cost in there too if you wanted to?
Yes.
Okay, so if you didn't have the land already, but you had it picked out maybe under contract or something along those lines, you could put the land in there, which I guess would be the first, that would be paid off at settlement.
The first draw would pay off the lot.
First draw, and we'll talk about draws. And then you would have the life of the loan, the construction loan product, and then there's options where that construction loan product can then turn into a permanent mortgage, and it can either pre-roll into one, or you can kind of shop for your permanent mortgage without having it automatically turn into one if you didn't lock that in from the start. So there are options.
There's definitely options.
Okay.
We have a unique product which is a one-time close, which that way you're going to closing one
time. One set of closing costs.
You're not paying double and triple closing costs. Our first draw takes down the lot. We do the construction financing. At the end, we modify you into your permanent loan. Very simple. Yeah. Sometimes people have a lot. And if in that case, they've already settled on it. So we'll pay off the lot loan at that point. Okay. Or we'll use the equity in their lot to put towards their down payment.
Because if they've bought the lot, and like let's say they pay cash for it, or they've paid off that mortgage, then they would have the option to utilize that. That lot equity sort of acts as cash, correct?
Yeah. As their down payment.
Okay.
Absolutely.
Yeah, because I think we've done that before, like personally with our personal stuff. I'm just making sure we're still rolling here. And then I also think it's really interesting with the draw schedule. So, all right, so we close, right? We close on the lot. We're ready to go. We're ready to put a shovel in the ground, start the permitting process. That is done. Money is released. They're not like, hey, here you go, builder. Let us know when you're done. We'll be good. They're going to make sure that everything is being done as prescribed in the documentation on a draw schedule.
Exactly.
So,
we can either customize the draw schedule if we have a builder that wants it a certain way, which is good.
Particular,
or we have our standard draw schedule, which a lot like to use. So, and so we will customize it to fit the builder's needs.
Which is nice too, because if there's certain things that, maybe a homeowner would like to have done first, then that's something that they can do. Typically, it's land getting paid off, and then the permit process, and then it's foundation or engineering, grading, all that, then the foundation, then the lumber, then the interior, things like that. So it does work on a draw system. Now, when you're doing those draws, a lot of questions that I get is, okay, how do the payments work? So I'm going to make these payments still each month, right?
Yeah.
But what are the payments based on? Do you have them where I've seen where it can be interest only?
It's interest only during construction on what you draw on.
Which is awesome.
So
I just think
as you draw, your payments go up, and at the end, we'll modify you into the permanent financing, which would be a principal and interest mortgage.
Mortgage, yeah. So I think that's good. And then I think a lot of people don't understand that you are just paying that interest. Now, granted, it's not paying down that principal balance, but I think that helps alleviate when you're building. It frees up maybe some of that liquid that you might have for a reserve, or, hey, honey, I want to change this chandelier, and it's not in our schedule, so, here, I'll take a little bit of extra cash, and we'll put it towards that. Things like that. So interest only, I mean, you're talking just pennies and dollars, really, maybe a couple $100 on the initial draw. And then again, as you take out those draws, your payments are going to go up. But it's nice to know that it's just that interest only until the project is complete, because again, it kind of alleviates, and then that also gives you time to figure out, if you're not into your permanent, if you don't just modify, that gives you time to maybe save up more liquid or something along those lines.
Some people want to switch programs or put more money down at the end.
Have you had someone do like a conventional construction product
and then they want to switch to something crazy?
Like FHA or something?
Oh wow. We can do it. I mean, but then they're going to closing again. So we try to avoid that. We want them to be in the product that works best for them, so we just roll it right into that product.
But if they're not ready and they're okay with paying a second set of closing costs, at least there's that option.
There is
which
always
I
that
think is always beneficial. Especially with custom building. I think that's always nice. So with that said, construction loan products are typically, you've got your main big guide that is for new construction only, right? But then I think you offer other construction-based products like 203Ks, I think we hear a lot of.
We got the home style, which is a conventional kind of a renovation loan.
There you go.
Or if somebody is building a primary or a second home or an investment property, we can do those on investment properties. Then you got the 203K, which only requires 3.5% down, which is a renovation.
Really nice. Now, could somebody do that like a refi 203K and pull money out to do work?
Yes.
Or they can buy a property that needs a little loving.
Which we're seeing more of that now.
Right? And then utilize that loan product. Now, is that something that can be modified into a conventional loan product at the end of the renovation?
Usually we refinance them out of that into another product as once they get the house done, because then it's going to be worth a lot more too.
It's going to be worth a lot more. And it kind of works the same way on draw schedules. So really, that's nice. So if somebody wants to do, an addition or major kitchen or basement renovation, they can call you and have you do a renovation loan and then modify it right into something that probably at this point would be a lower rate. So let's talk about rates. So what are we seeing? I know COVID had a huge impact on a lot of different products. We had personally, experienced a mutual client where COVID affected their loan product. So are you seeing things that what happened? Did things get shut down?
It did. I mean, it all got tightened up, when COVID hit, because a lot of people were putting their mortgages into forbearance, which we can't lend if somebody's not paying their mortgage, even though you were allowed to do it. We had people losing their jobs, so that tightened up on, at the end, us having to verify their employment within a 48-hour of closing. I mean, that's kind of lightening up now. Now we're at 5 to 10 days. It was just guidelines, the credit score limits. We had products for low credit scores. Now they've kind of upped it. So that hasn't quite come back yet. That's the only thing I haven't seen come back yet.
A little tighter.
A little tighter with that. A little tighter with the jumbo products. The more risky things have tightened up a little bit. Nothing's really gone totally away. I guess the only thing we don't have right now is the construction perm jumbos, but they're coming back. Yeah, because the jumbos have come back. So it's just slow to follow.
And I guess what it is some of these investors that are backing these products that would buy them on the secondary mortgage market, they get a little nervous when you see some ups and downs and some things that you've never seen in the economy. So I can imagine.
Mainly people losing their jobs and not working right now, and the foreclosure rate, things like that.
So that's the other thing. I mean, with forbearances, is that something that once that term with forbearances is done and they've paid whatever would be due at the end of that, would that have a negative impact? Like, will that come up? Hey, I did a forbearance. I did it the right way. I paid it appropriately when all was due. Yep. But does that show anything when you're reviewing? I didn't even think to talk about that, but now I'm curious.
Not really. I mean, as far as we know, it's not going to report late because it's allowed. And once they're back out of forbearance and showing that they're making their payments, we should be fine. You know, some of the forbearance things have ended September 30th, you know, some of like student loans and stuff. But,
That's right, so the whole 4 months,
so, you know, we're still counting those payments in the ratio but until they're out of it, we really can't lend. Until they're back to work, we can't lend. You know, so
I mean, it makes sense.
It definitely has tightened up on the credit score minimums and things like that.
Yeah, the other thing is, for example, like with conventional loan products, a lot of people say to me, Rachel, I don't have the 20%, I don't have the 20%. Well, that's all well and good. And I think majority of Americans don't have the 20%. So typically I say, hey, look, there's options for a 3 or a 5 or a 10 or a 15. Like there's different conventional loan products. Are we still seeing that that's available?
We still have zero down. You know, we still have, we can do the USDA. For veterans, we still have zero down.
Yep.
We still have the state grant programs that allow, you know,
there's still options out there.
And I think options.
That's what I wanted to just make prevalent known. Hey guys, we're still good. We're still doing things. So don't hesitate to reach out. So with that said, construction loan products, real quick, just jumping back to that. Are there so there's a conventional construction. Are there FHA, VA, or ARM conventional loan products?
There's definitely ARM. We can flip them into the FHA and VA at the end. So that's possibilities. Yeah.
So really,
we do everything in-house. We have in-house processing, closing, underwriting. We have a department set up just for construction perm. So we...
which is very nice and very organized and streamlined. We know personally.
Yes. It just flows. It works good. The one thing that makes us different and really makes us good as far as a lot of the industry doesn't do this is we send our inspectors out to the sites every 2 weeks, whether the builder calls for a draw or not. If we see that draw 2 is at 50% stage, we'll issue the draw. So that way we never slow down your building.
You never slow down, and I think that's been beneficial too in just keeping up because not only does it help the builder, right? It's a two-party situation here. It's helping the builder keep going. He's still moving. He can get payment out to his subcontractors, materials, whatever needs to be done. But I think having the inspector go out twice is also a benefit to the consumer. To make sure, I mean, the bank's, again, not just going to be like, here you go. Call me when you're done. You know, they're going to make sure that everything is getting done to a T.
We're looking at that project every 2 weeks. We're making sure it's not stopping. We're making sure that we're not holding up anybody's money, that we're issuing the draws, partial draws if we need to.
Which is nice.
Keep it moving.
Yeah, which is nice. So we talked about jumbo loan products and then county limits. I think a lot of people don't understand sometimes, and even with me, I'm ignorant to it, and it's hard to understand that each county has their loan limit. Right? So explain what a loan limit is, how it affects consumers.
So every year they kind of set a conforming limit. Sometimes it stays the same. This year for 2020, the conforming limit is 510, 400. So that means anything under that is just a conforming loan, and
it's
that's
normal.
where you're gonna, normal, exactly. And you're gonna get the better rates at that. Then you can bump up to the county limits. Now for Maryland, you're gonna have like your Washington area counties. You're gonna have your Baltimore area counties, and it kind of draws a fine line where you're going to have 520, 950 is going to be the Baltimore area, where the Washington area is going to be a lot higher, 765. So so that
would be like Montgomery County. Obviously, the loan limit's higher.
Exactly.
Because, the values are
765.6 for those. So that's and then once you exceed the county limit, it becomes a true jumbo. And that's where you're going to need the 20% down. It's a little stricter. It's more of investors that buy those loans. It's not Fannie and Freddie related. So
So the guidelines are a little bit more strict, or a little bit more scrupulous on qualifying.
They are. Yeah.
Okay. Well, that's because I'm always like, man, the jumbo loan products, and of course that pertains to construction as well. So it's like, man, that would be good information to get out there, because I don't think a lot of people realize that there's a cap to how much you can borrow before it costs more money for money,
right? Exactly.
It costs more money for money. So it's interesting to see all the ins and outs, but all in all, it sounds like with COVID rearing its ugly head, we've still been charging along.
Yeah,
and things are good for
we're
the most
busy because the rates are at an all-time low.
Yes.
And people want to buy when they're low.
So wait, can you give an idea of what the lowest you've seen on the market?
It's very credit score, equity, and program driven.
Okay.
So that's why, everybody can see a little fluctuation. They might say their neighbor got a better rate than them. Well, their credit scores could be worse.
Exactly.
So you gotta have good credit.
That and I think it's also who you're doing your lending with. Because each lender is going to offer different products that they may be able to access and convey back over to you better than some others.
We have programs that allow low credit scores. We have other ones that, you need really good credit scores. So it's going to be a little different. Yeah.
And then with like vacation properties and second properties and investment properties, a little bit different qualifying factors. Yeah. Are we seeing that the rates are still pretty good, though it's a secondary structure?
Yeah, I see more investors buying now because even though there's a bump in investor rates, they're awesome.
They're still awesome.
So investors have to put 20-25% down is most programs for buying investment property. Second homes are great though, 10% down, and the rates are almost as good as primary. So now's the time to buy your beach house.
Right. Buy your beach house, buy your lake house. And if you need it built, you can call me from Home Innovations, and we'll custom build it, and we'll do the construction. We're already approved. So with that said, you work with builders that have to be approved, correct?
Yes,
Right?
If somebody comes to me with a builder, we have paperwork we fill out. We want to make sure that they're paying their subcontractors, that they don't have anything bad things out there.
Up and up, crossing T's, dotting I's.
Exactly.
Yep. So it's not horribly scrupulous, but it's always nice that they're investigated to make sure that they are a reputable builder. So that's really good too.
Yep.
With that said, guys, as we're winding down, I wanted to do a quick screen share and show you Kathy's website, and it is www.kathybrennan.com. Really, this is
Kathy A. Brennan.
Kathy A. Brennan. I'm so sorry. I'll make sure that that's appropriate. But boom, there you have it, guys. Look, you can apply right online, and it's so streamlined, and it's also very mobile friendly. So I think there's a mobile app as well that you can download. So that's that. So tell me about the mobile app. Can your guys
they can apply online? They can see their status of their loan. They can upload documents. When they're building a house, they can see when the inspectors go out. Everything is at their fingertips on their phone.
And I love it. Look, you can take pictures of your tax returns. I mean, is that something that you see people do a lot, where they're turning in their documents? Just from taking pictures like that?
Yeah.
Yeah, I mean, that's pretty awesome. So again, kathybrennan.com. And then here is her email, kathy.brennan@rmsmortgage.com. Right? Yay! And all kinds of different products that we have out there. But I really wanted to take a moment and talk about construction loan products and how awesome they are and how fabulous she is.
Thank you.
And I think I've got to toot your horn for a second. Because one of the main things that I love about working with you, and we work with a couple, we all work with different people in the industry.
Absolutely.
But I love that you take the time to educate our clients. And if they need hand holding, you're there. I think that's some of the positive feedback. I mean, I've only gotten positive feedback from it, but that's some of the feedback that I've gotten, that a lot of my buyers that have worked with Kathy have said how much she, teaches, and the knowledge base and the hand holding. And so it's really, it's really nice to be able to, and even if it's a second, because a lot of people don't do this all the time, I just love the communication ball gets bounced pretty high. So I just want to say thank you so much for that. And thank you so much for coming on, guys. We appreciate you tuning in. If you have any questions, I will post all of her contact below. And again, www.kathybrennan.com will take you directly to a mortgage application webpage, and that's it. I think that's it.
Thanks for
having me. Thank you so much. All right, guys, catch us on the next show. Bye.